On that, what is our current debt load in America today? Very close to $23 trillion. So if we couple our federal deficit and our debt load in America today, I think the point that we made earlier that taxes are very likely going to go up. Very likely to go up. What is a number that we're told that's a safe percentage of your pre-retirement income as a percentage base to retire on? What percentage of pre-retirement income does the world tell you that you're going to be comfortable with?
60.
About 70 to 80. Okay, so the media outlets, Forbes will tell you, hey, if you can retire on 70 to 80% of what you were accustomed to making, you're going to be pretty comfortable. So having been in the business for over 20 years, I can tell you, don't believe it. Don't believe it. Because when you add in medical expenses, potential long-term care, right, throw in a bit of travel, I would encourage you to plan to retire on 100% of your pre-retirement income, if you can do it. Every one of our clients that comes in to meet with us, we do a budget, we do a projection of what retirement income or retirement needs may look like, and we begin to structure income to make sure that we have enough to handle travel, medical expenses. 70 to 80% is really, really a short number. A couple of ideas for you. Has anybody heard of a Roth IRA?
Yes.
Have any of you looked at strategy to convert your current taxable accounts to Roth IRAs? Has anybody taken a look at that strategy?
I have, yes.
Okay. What have you found?
I found that a big tax burden right now to do that, so I don't think it's.
Okay.
But at this point, I mean, I'm speaking with people, but it's not financially sound for me to do it right now.
Okay. Okay. So conversion of taxable accounts, if we believe that taxes are going up, everybody raise their hands, and you're sitting on a taxable account, an IRA, a 401k,
Right.
some form of qualified account, you could be sitting on a tax time bomb, okay? Roth IRA conversions are still very, very productive. You don't need to do them all at one time, right? It can be done incrementally over time. So there are strategies that you can employ, all right? We have a high-level CPA that we're affiliated with. I'd love the opportunity to talk to you about how to convert some pre-tax accounts into tax-free accounts utilizing the Roth IRA conversion. Has anybody heard of the Stretch IRA? For those that are concerned about your IRAs and who they're going to pass to, anybody familiar with a Stretch IRA?
No.
Making a grandchild, for example, the beneficiary of an IRA on a $100,000 account at about a 7% average annual return could turn into millions of dollars over time if structured correctly. Okay, so just two general ideas. If you want to throw those ideas down on paper, I'd love to share more with you on the Roth IRA, utilizing that as a very effective tool, and also Stretch IRAs, just as a few general ideas.
Does it need to be a generation skip for the Stretch?
Absolutely. That's exactly.
Cannot be sons and daughters.
Yep. To be effective, a grandchild, something to that effect, okay?
Can you take your the minimal, like when you turn 70 and a half, can you convert that into an IRA when you withdraw it?
No, unfortunately not. The required minimum distribution, everybody familiar with an RMD at 70 and a half, the required distribution from a qualified account, that must be withdrawn from that account, taxed, and then unfortunately you can't put it into an IRA, okay? But I'd love to talk to you about RMD strategies. Anyone that has concerns of how to handle RMDs, we're very fluent in that area. The second topic I'm going to talk about tonight in your booklet is going to be Social Security. How many of you in the room believe that you will count on Social Security as a key component of your retirement income? Or if you're there, are counting on it as a key component of your retirement income? Can I see a show of hands? Most of my clients count on it in one form or another. What do you think the two critical questions I get regarding Social Security might be in almost every appointment I go into?
It's gonna still be there when I need it.
Right.
Will it be around? We'll talk a little bit about that. What else?
Is it going to decrease in value or
Is it?
cut it?
Are they going to make cuts? We'll talk a little bit about that.
Yeah.
How about when to take it? Okay. So the estimated average monthly Social Security benefit among all retired workers in 2016. This is on Social Security. Question number 1. What do you think the average benefit was at that point on a monthly basis? Anybody want to take a stab at that? 1,404, 1,404 a month. Okay. Question number 2. I'm going to make a point here. The maximum monthly full retirement age benefit in 2017 was how much?
70?
The amount. The monthly amount.
Monthly. 3,400. 1,800.
$2,788. So the average monthly benefit was $1,404. The maximum benefit was $27, almost 50% higher. Why do you think that is?
They took it later. They waited.
Because people are
Took-
taking it early.
Taking it early.
right.
How many of you know folks that as soon as they were eligible took the benefit because they didn't know any better? Right? Or out of fear of the program disappearing, let me get my hands on my money while I can.
I'm one of them.
Right?
Yeah, but you only work part-time.
The other areas, a lot of folks maybe report lower earnings over the course of their career for those that are self-employed. So there's a lot of reasons in there, but I think the key one is taking it early and not knowing how to activate the benefit and how to leverage that benefit. We can help you with that. Question number 3, your claiming age decision could impact your spouse's blank benefits.
Is this a true or false?
No. Question number 3, your claiming age decision for the married couples in the room. You claim it early, it could have an impact on what benefit to your spouse? The survivor benefit, right? You think about that. Husband claims the benefit early, right? He passes away. The surviving spouse is going to receive a lower benefit than if he would have delayed in that example. Okay, so I think it's worthy of examining what your options are, when to effectively activate your benefit. Anybody know what the percentage increase is in every year that you delay taking your benefit?
It's 8%.
8%, very good, right? 8% annual increase. 5 years, that's a 40% higher check
But it's only 8% of the first year. That's the same thing you get every year.
every year.
Right.
Absolutely.
You don't get it like when you add 8% on, then 8% of that next year. It's all the same 8% that you get.
You're talking simple versus compound?
You get $300 more a month. The next year you'll get $300 more a month. The next year you'll get $300, whatever it is.
Simple interest.
Yeah. Yeah.
Compound.
So think about when you're activating your benefit for those in the room that have not yet activated it. By the year 2035, there will be how many million people, Americans, age 65 and over?
90.
79 million
That's the first I put.
folks. 79 million. This social program was designed to take care of folks for a shorter period of time, not to mention that we've got, we're an aging population, aren't we? Right, the baby boomers. We've got some problems. A good friend of mine, Sean, who's an advisor, he does exactly what I do down in South Florida and Connecticut. We were up in Pittsburgh for a workshop. And we had a high-ranking Social Security individual there educating us on what's going to happen to the program potentially. They're clearly going to run out of money in the year 2035, or the reserve will run out in the year 2035. The program completely goes defunct in the year 2085. So the strategies the strategies that they're engaging in and thinking about is raising the FICA tax, right? Raising tax, to our point earlier, to be able to support the program. There's even been talk about cutting the benefit by 15 to 20%, but that'd be political suicide for whoever does it. So highly unlikely is what they told us, right? But I believe it's very important as you look at your retirement income. Tonight in the room, you said, how can I grow my money? How can I grow it safely? How can I protect it from the markets? I want new ideas. You know, we hear this every day of the week in our practice. I think it's worthy of looking at strategies to protect yourself. We talked about taxes, rising taxes, Social Security. We don't know what's going to happen. There's nothing definitive there. But I think it's important to look at your income, what your needs may be in the future, and develop strategy to generate guaranteed income to yourself, to keep up with these potential risks. Anybody have any questions so far?
At what age can you start taking Social Security?
62 is the earliest age.
What's the latest?
70. 62 to 70, anywhere in between. If you're thinking about taking it early, you got to be careful for the amount of income that you're bringing in so you don't get penalized. I've had folks do that before. I'm going to move on. I'm going to move on to our third topic. Let me ask you, how will inflation impact your retirement savings over your lifetime? Has anybody really thought about what inflation could do to your retirement?
Yeah.
Wipe it out.
Any money left?
Eat away at your money. Take a look at the little chart that we put together for you. The staggering one is a new car. In 1975, a new car cost $3,800. In 2015, $31,252. A 722% increase. I call this a silent killer in your plan. Right? I've got clients 10 to 12 years down the road. They'll come to me and they'll say, hey, Greg, I've got the same income coming in. I haven't changed anything, but it's not going as far. What's going on? It's inflation. It's eating away at you. What do you think the number one expenditure is for retirees? The one area that's inflating through the roof? Your medical expenses. Medical expenses are going through the roof. I did a long-term care workshop in Oviedo the other night, and we talked about the cost of long-term care, the greatest risk that we all face. It's staggering, the cost of long-term care, over $100,000 a year for one individual right here in Central Florida, right? You need 3 to 4 years of care. How quickly would that wipe out a $400,000, $500,000 nest egg or more, right? So these are areas that at Brick Retirement Group we sit with our clients. We don't leave any rock unturned. We look at inflation. We look at your taxes. We look at Social Security. But inflation is the one that scares me the most. I had a high-level CPA. It was staggering to me. She brought in her financial plan and compared it to mine, and she said, Greg, there's a discrepancy here between what I've done and what you've done for me. And I looked at it, and she had forgotten to factor in inflation into her numbers. It's amazing what 1% of inflation will do to your retirement income. Staggering. We've got an incredible calculator we do with all of our clients, we use with our clients to show them the impact of 1%, 2%, 3%. Anybody know what the average total inflation rate is over the past 10 years, the average currently? 1.54. We've been in a very low inflationary environment, right? The 100-year average, anyone want to take a stab at that?
3%?
It's close to 4% if you average the last 100 years out. So very important in your financial planning that you look at inflation.
But do they count gas or food in that?
Yeah, they've got that bucket, don't they, of all the items that we as consumers use.
Food or gas?
Yeah, absolutely. I agree with you. I might up that number a bit. the number that we're given. Inflation. Keep a real close eye on it. I'm going to jump on to market volatility, our final topic for tonight. Anybody remember 2008, 2009? What happened? What happened?
Real estate.
Real estate crash. What else?
Investment.
Stock market. What else?
Housing?
Real estate. What else? Gold. What else? Silver. 2008, every asset class crashed. Every asset class. So for those financial advisors out there that were saying, hey, the 4% rule, withdraw 4% of your nest egg and you're going to be okay. You'll never run out of money. That method of asset allocation has completely failed. All the rules changed after 2008. All the rules changed. So, number one, the major market indices have individually recovered by how much? How much has a Dow recovered since 2008? 224%. The S&P has recovered by how much since 2008?
300.
Very close. 296. Well done. What about the NASDAQ? It went on a tear. 426% recovery. So we went through this sharp dip where everything crashed. The markets collectively have recovered 315% roughly. Question number two. Market corrections happen how often on average?
7 years?
4 years?
4 years. Average bull market is how long? Average bull market. 6 to 7. How long has our bull market been? How long have we been in this?
Over 10 years.
Over 10 years, right? Where do you think we're going?
So ultimately, there's always going to be a downturn.
It's always going to, naturally.
The question is how deep does it go? Is it shallow? Not every recession is 2008 is more of an anomaly. And if you look at all through the market cycles.
100%.
And do you have enough time to recover?
That's the key.
So let me do something for you on that note. Do you have time to recover? Inside your folders, I put something in here for you that I want to explain. And you're not going to hear this from a lot of folks out there. It's sequence of returns. I want you to take this out. For those of you that are looking at your brokerage accounts, you're looking at your annuities, you're looking at your mutual funds, keep in mind we're at a peak of a bull market right now. And I'm going to, again, I need everybody to take this out. I really want you to comprehend what this means. The heading is sequence of returns. You've got two couples and they each have $1 million. And they're retiring and they're going to draw $50,000 a year from their $1 million portfolio. There's an inflation factor in there of 3.5%. But both couples have the same average annual return. Their average annual return is identical. Couple number one in orange, I think it is on our sheets here. What do you notice about their rates of return in years 1, 2, 3 relative to year number 4? I need your help. What did they earn in year 1 in the orange box? 27%. Year number 2, they earned how much? Year 3? Year 4? Negative 15. Now go to the the green box, read those numbers off.
-15, they started.
Negative 15, 7, 9, and 27. What do you notice about the numbers?
Inverted.
They've just been inverted. Add them up, divided by 4, you have the same average return, don't you?
Yeah.
Well, go down to the chart. The couple that had negative returns while they were withdrawing, to the point made in the back of the room, how long would it take to recover? Your greatest fear is a decline in the market and a withdrawal. Think about the forced withdrawal, whether you like it or not, in the form of an RMD in a down market. The couple that had negative returns in the beginning ran out of money 13 years ahead of the couple that just simply had positive returns in the beginning. Has anybody heard of this risk? Every dinner I do, I think maybe 1 or 2 people have heard about this and actually comprehend it. What you don't want to have happen is a decline in the market and a withdrawal. A decline in the market and a withdrawal over a sustained period of time will hurt you. What is the greatest fear in retirement? Running out of money. What's the second greatest fear?
Health.
Health, long-term care.
Not living long enough to spend your money.
That's a positive way to look at it. Positive way to look at it. Does anybody have any questions on that concept? What we can help you do, and it's funny, I was talking to my friend Sean a little bit about some of the meetings that we've been having. We're encouraging our clients to protect themselves. And frankly, many of them are asking us to protect them. It's a good time to think about it. Anybody heard about an angry tweet? Who's the king of the angry tweet?
President.
The angry tweet. Do you know an angry tweet alone has been proven to have a negative impact on the market? Just the tweet, to show you the world that we live in, right? And you couple that with the trade wars with China, what's going on in the Middle East, you've got Brexit, you've got the inverted yield curve, you got the pending election. There's so much going on in the world right now. I encourage you to think, really stop and think about what you're doing. You have an opportunity, right? 2008 may have been different for a lot of you. You may have been working, some of you. But if you're approaching retirement or in retirement, timing and sequence of returns is a very, very real risk to you. Okay? We can help you with that. Is this my booklet or yours?
Mine.
I'm going to borrow it for a moment. Does anybody have any questions? Anybody have any topics they would like for me to address? Tonight was all about me touching on a few broad topics, not to give you answers to common problems. I'd love to meet with you to talk about those, okay? And I'm offering up a complimentary meeting with me where we can get a little deeper into what your concerns are, what your fears are, and how we can help you.
I have a question.
Yes. Mm-hmm.
What are you suggesting? If the market goes down, you don't withdraw money?
Yeah.
How do you do it?
Well, that's a concern, right? If you can afford to weather it and not touch your assets, you know, and a lot of folks will do that. They'll cut back their spending, but there's strategy that we can employ. I'll give you a great example, income allocation. We don't believe in asset allocation anymore. Asset allocation, meaning putting a little bit in large cap, a little bit of mid cap, a little bit here, a little bit there, and you'll weather the storm. We'll put a rain jacket on you and you'll be okay. That doesn't work anymore. At the higher levels, it's about income allocation. And what income allocation is taking care of what your income needs are in a guaranteed fashion. Right? I had a gentleman come meet with me today at my office this morning, and him and his wife just simply need a little more additional income. And his current advisor is so conservative. He said, my advisor is just so conservative. I'm almost better off keeping my money in the bank. And I said, look, I mean, to be fair, he's trying to protect you. It's a very volatile period. But there are strategies, for example, annuities get a negative connotation, don't they? Right? Would you agree? What you hear about annuities generally are bad. But there are all types of annuities. Annuities are no different than a stock, a bond, a mutual fund. They're a tool. There are ways of guaranteeing income to you and your spouse with inflation protection. As a matter of fact, if you knew that you had your income covered in a guaranteed fashion, wouldn't it allow you to be a little more aggressive on your investments for the longer term? So that was my conversation this morning. If we solve your income need, your shortfall, for you and your wife to be comfortable, you could actually branch out and afford to leverage the markets in this downturn that we're going to go through here, right? So there are strategies that we can employ, right? The number one concern is your income. To your point, I'm answering your question, is that what if you need to rely on your asset and you do go through a market downturn? What if you were to carve out part of that asset to generate the income that you need and then allow the other asset to grow in the markets? Right? If you knew you could cover your housing, your food, your medical, your dining, your entertainment, all those categories in your budget, if you knew you could cover that in a guaranteed fashion with an inflation protection component, would that make you feel comfortable?
Yes.
So those are the areas that we look at when we meet with our clients, is how do we secure your income, number one, and then how do we continue to grow your assets for the longer term? How do we protect you against the high cost of long-term care, your number one risk? It's not your home burning down, right? It's not getting into a car accident. Your greatest risk to your nest egg is long-term care. Hear me out on that, right? You hear it. I think some of us have gotten numb to that risk. Look at how to protect what you have and what you've built over the course of your lifetime. Look at your long-term care. Make sure you're in the right Medicare plan, right? You got Advantage plans, you got Medicare supplements. They're doing away with Plan F in the year 2020. Make sure you're in a very good health plan. Yes?
You said they're doing away with Plan F in 2020. If you're already grandfathered in, though, you can.
That's correct. You're okay.
Are you better off keeping it or?
They're okay. Yeah, in my opinion, the Plan F is a very, very good plan. It covers all of the excess charges of Medicare. It covers 100 days of skilled nursing care that you need.
But he's trying to talk me out of it.
Well, look, the one reason to not remain in a Plan F or a Medicare supplement is that it's less expensive to go to a Medicare Advantage.
Yeah.
I mean, that's the only reason.
But if you
But
need,
peace of mind.
Well, you keep your own doctors too, you don't have to go to a network.
Correct.
That may or may not have your doctor.
That's correct. Yeah, you jump in.
Figure out the cost difference, there's not much different at the I mean, assuming you're not totally healthy, you're really healthy, then you're probably better off in the HMO or whatever.
Yeah, it's all relative. Everybody's a little different. But, I think the point is, and we can help you, wade through all the options that you have to make sure you're taken care of in that area. Taxes, don't overlook taxes. They're going to go up. We're actually in a very favorable environment right now. 2019, the standard deduction for married couples has doubled, right? Great time over the next 3 to 4 to 5 years to begin thinking about diffusing that tax time bomb that you have in that IRA or 401k. And again, it may not work for everyone. To your point, you might look at it and say, whoa, that's a pretty heavy tax bill. But where might it be in the future? Are you better off dealing with it now? We can help you look at that mathematically with high-level CPAs and determine whether or not it's feasible. For some clients, it isn't. For some, it is. So really think about your taxes. Inflation, a real basic one for you. And I put a little brochure in your packet titled Lazy Money. Someone said, how do I get my money to work for me? How much are you earning in the bank right now? I had a client come to me. She kept this from me. $500,000 in a savings account at the bank, and she finally got angry about it. and said, Greg, I can't take it anymore. $500,000 earning 0.10 on $500,000.
Yep.
Right? So folks feel good about holding on to their money, right? As long as they can see it, they're okay. But don't forget inflation. If we believe in that, this is an example of $100,000, a 3.5% inflation rate, earning a fraction of an interest rate in the bank. 0.10 is the example I'm using. After 1 year, you still have your 100,000, but you've lost purchasing power. Right? Can anybody read that number? Your $100,000 actually has purchasing. You've lost $3,400 of purchasing power. What's the number after 5 years of letting that money sit in the bank?
18,260.
You've lost over $18,000 of purchasing power. This is not a joke. These are real numbers. And the staggering one, you go out 20 years, you've almost lost 100% of your purchasing power. We have fixed accounts right now right around 4%. And if I do the math for you over a 5 to 10 to 15-year period, just a 4% rate of return relative to 0.10, it's staggering what we're putting into your pocket.
What would a 4% be, like a fixed index?
Fixed annuity. Yeah, pure fixed annuity. Yep. Some of my clients like the idea of an FIA, a fixed indexed annuity, where you have a floor at 0. We tie the money to varying indices. We got an array. We got the standard S&P, the NASDAQ, the Russell. Andy, I think I mentioned to Andy or Joe, I had a client hit a 7% return tied to a real estate index. Again, no risk at 0. So if the markets go kerplunk, you don't earn anything, okay? But I had a client hit 7% right now. Their crediting happened, a week ago. Ecstatic. Market-like returns without being in the market with no fees. You make a time commitment, though. In this case, a 5-year time commitment. So nothing magical. There's tools out there that you can use and you can leverage to get your money to work and work safely, right? I think a lot of what I heard tonight is, Greg, I want to earn money. I don't want to take a whole lot of risk. I just want to earn a reasonable rate of return. Would love to talk to you about ideas on that.
You talk about long-term care. If you don't have long-term care insurance, then what do you use without wiping out your savings?
So here's what would happen. No way. There's no way around it. One way, you could give away everything that you own irrevocably. You with me on that? There's a 5-year look-back period, so if you happen to get caught, then you're held liable for that cost. But right now, if you don't have a long-term care plan, Medicaid is your insurance program. You will run through all of your money. You hit $2,000 left. Now you apply for welfare, Medicaid, and then Medicaid only pays for nursing home care. It doesn't pay for assisted living. It doesn't pay for adult daycare, nor does it pay for home health care. So when I meet with clients and I do my long-term care workshops, they're shocked. They've been misled into thinking they can bypass the system. There's no way around it.
I should have had this 20 years ago.
I have incredible ideas for you on long-term care. I'm going to share one with you. Traditional long-term care is dead. Traditional long-term care insurance, where you're buying a daily benefit over a benefit period, have gone away. Life insurance companies have now come in and they're commanding the long-term care arena. So you can buy a life insurance policy, okay, with a long-term care benefit linked to it. And in essence, what you do is you pay down the death benefit over the course of your lifetime. If you get into a long-term care scenario, you're using your death benefit for long-term care. A great way to leverage an asset and to protect everything else that you have.
what if somebody owned a home and they decide they're gonna sell their home? Wouldn't the equity in that home, let's say somebody's been living in their home for 40 years and they got a lot of equity, wouldn't that cover long-term care? Some of these.
Okay, wipe it
So,
out.
so if I'm hearing you correctly, let me give you a scenario.
Okay.
You get sick. He's okay. You sell your home. Where does he go?
Live with the kids.
Right, but now you get in. Now you open up a can of worms. So I joke around with my daughter.
Have an extra room.
I joke around with I do not want my daughter bathing me. I will not put my daughter and my son-in-law through that. I'm 50. I've got my long-term care plan. Right? I bought my large life policy. It's got a long-term care. I'm done. I'm going to age in dignity. Taken care of. Done. Yeah.
Some of these say there's a 5-year look back. In other words, they're looking at this as possible fraud. How do you know 5 years ahead that you're going to get that sick, that you're going to have to give everything to them for them to take care of you? What do you mean by a 5-year look back?
They don't want you having an inkling that you're sick, giving everything away so that Medicaid can cover your long-term care bill. But
I understand.
yes.
But there's times you don't know. In other words, if they can prove fraud, of course, but if
Well, let's say you engage in an irrevocable trust. You give everything away that you own,
you
right?
have children who are going to take you in later in life.
Well, if that's your plan, but now if you go beyond that 5-year period, you've made it. You're free and clear, right? So what they're saying is that if you engage in this arrangement, you give everything away, and within that 5-year period after you've given everything away, you run into a long-term care scenario, they're going to hold you liable for the long-term care bill. They're going to require you to go back and utilize those assets to pay for long-term care. If you go beyond that 5-year period, and now you're free and clear, a long-term care scenario happens, then Medicaid will pay your long-term care bill.
You're going to go to your children who you gave the money to and take it from them.
There's a look back. They'll hold you liable. Yeah.
You have to be able to prove fraud or something? I mean,
No. It's just a rule that, within if you're going to engage in this scenario, if a long-term care event happens within 5 years, we're going to hold you liable for the bill.
And if you don't pay your bill, they cancel you. Right? Long-term care? We had to get...
Oh, no. So let's make sure you and I are talking. I'm talking about Medicaid, the Medicaid process of giving everything away. Is that what you're...
No, Medicaid, that was the one question, but we have long-term care.
Yeah.
If we miss one payment,
Yes.
we're canceled.
You're canceled.
Done, over.
Yeah.
Okay.
Yes.
No, I wanted to mention another catch as a Medicaid thing. I ran into this with my mother who lived to be 95. She was going over $10,000 a month in her assisted living, New Jersey.
Yep.
And I started to get nervous and I was looking into her possibly getting on Medicaid at some point. And because she had 2 small pensions and my dad's VA benefit, she was over the $2,000 a month limit, and she would have to get what's called a Miller Trust.
That's right.
Whole nother can of worms.
Whole other can of worms.
Keeps you off of Medicaid until you
Yeah.
straighten that all out.
And they'll take those checks away, by the way.
Yes, I
Yeah,
know.
those checks will go to that bill.
I was a little nervous.
But folks, what I will say on the long-term care, get with someone who really understands how it works and how to insure against it. All right, develop a written plan. That's an area that we would love to talk to you about. I know your meals are coming in. I want you to enjoy your meals, but the ladies are going to come by at a given point and look, set up a time, get with me. We're not going to charge you a fee to come in and sit down and talk to us, okay? We'd love to talk to you about all these topics. Yeah. Oh, yeah, of course.
Is there an age at which you cannot, you're too old and you can't buy the long-term care?
Well, that hinges on health, number one, and number two, costs. The longer you wait, I would say it becomes cost prohibitive around age 80. The life insurance companies have become a lot more lenient on the underwriting, which is a good thing. Okay, I've got clients who have diabetes who have been approved, okay? But I would tell you, you really want to look at it between the ages of 60 early 70s is the ideal range. I wouldn't discount it. I would look at it, right? And we'll take a look at it and determine whether or not it's a viable solution for you. Okay? Yeah.
My question, if you don't have to use the long-term care, that's the life insurance policy that your family would.
That's the beautiful part of it. The traditional route was you make your premium payment. If you never used it, you wouldn't have anything to show for it, right? Now you've got a death benefit. And in addition to that, you've got cash value in the contract. So you live a long life and you die not needing long-term care, your family will get a tax-free death benefit. You live a long life, you've got some cash value build up in your contract.
Yeah, but in some of these independent living places, they allow the couples to stay. That was another point, because you said, where is he gonna go?
Well, yeah.
So if I have to go into an independent or assisted living and he still has his faculties, or let's say, there are facilities that I know in the villages where couples do stay in the same room.
Yeah.
So that he wouldn't be left to go to his daughters.
Right.
So there is that option too.
There is, and I think
Share a same place.
I think long-term care could happen in a lot of different ways. What if someone has a stroke and, they've got around-the-clock nursing home care? That
Right.
scenario wouldn't work. I think if you start playing out different scenarios, we just don't know what it looks like. You may never need it.
You never know.
Facilities you go to.
The one thing I'll say about it is be in control of your care.
Yeah.
The minute you start engaging in Medicaid planning or not planning at all, that's where it can really. I've lived many scenarios with clients. It's a rough one. You want to be able to be in control of where, when, and how you receive your care with the least amount of costs. Right, leaving your assets intact without putting the pressure on family and friends. I don't think anybody wants to be a burden, right? So.